And natural resources and precious metals underperform for a substantial period of time. So what we've seen now is reversion to mean. I believe that this is also prescient because I don't believe that we'll merely revert to mean, but as often happens, we'll go across the mean or the median line, which is to say that we'll go higher than mean. And ultimately, I guess, perhaps after my passing, return again. Let's look at two different subjects within your question. One is precious metals. We can talk about why precious metals are doing well, but I think we can sum it up by saying precious metals do well when fear around the continued purchasing power of fiat-denominated savings and investment assets is growing. And I think that fear is growing. We can talk about why if you like, but I think it's enough to say right now that it is. The second is industrial materials, the stuff we need to maintain our material standard of living at the level to which we've become accustomed. A couple things are happening here. Over the last 40 years, we've done a wonderful job of making 2 billion people on Earth much less poor. Poor to be sure, but not starving any longer. Those people, Adam, want to live like you and I do, and increasingly they have the means to compete with us. At the same time, of course, there are more people every day. While that goes on, I would argue that for 30 years, we have underinvested in productive capacity around natural resources. If you don't make sustaining capital investments, your ability to produce falters at the same time that demand is growing. This is all very simple stuff. And that's a long-winded way of saying, yes, I do believe that we're coming into a bull market in natural resources, but I think the price performance that we've seen thus far is merely reversion to mean.
In today's video, financial expert Rick Rule delivers a chilling analysis of the current economic landscape. He reveals that the US federal government's on-balance sheet liabilities exceed $34 trillion, while off-balance sheet liabilities like Medicare, Medicaid, Social Security, and pensions surpass a staggering $100 trillion. Rule explains how precious metals are set to soar due to growing fears around the purchasing power of fiat currencies and decades of underinvestment in natural resources. Are we on the brink of an economic upheaval? Rule believes gold could hit $9,000, driven by circumstances that could severely damage other parts of your portfolio and overall economic stability. Moreover, he highlights the alarmingly low market share of precious metals in US investment portfolios, predicting a significant increase in demand as investors seek safe havens. Precious metals currently make up less than 0.5% of all savings and investment assets in the US, a stark contrast to the historical mean of 2%. This potential reversion to the mean could quadruple the demand for precious metals.
Oh, I think we're about through reversion to mean. Now, maybe I look back further than others. In other words, maybe at 71, what constitutes reversion to mean takes a longer period of time. But as an example, if you look at the gold price over the last, say, 2 years, we have a, 22% gain? I think what we've really seen there is reversion to mean. Similarly, with regard to the oil price, we had this unbelievable sell-off around COVID. To the point where oil was selling at a substantial discount to what it cost to produce, never mind the cost of capital. So we've had reversion to mean there too. So if the question involves where are we in terms of reversion to mean, my suspicion is that we're there. In most commodities, most industrial commodities, commodity prices allow for both the payment of social rent, which is to say tax and royalties, and also the earning of the cost of capital, but no more. Similarly, with regards to precious metals, while gold isn't loved, it is at the point where most people can at least spell it. So I would suggest that with regards to the baseball analogy, in terms of reversion to mean, we're there. In terms of the bull market, I think we're probably in the second inning. We're very, very, very early on. Things seem to progress more quickly these days than they used to. So I'm not prepared to put sort of time numbers on it. But perhaps we could talk in a very broad sense in dimensions. Let me give you a couple of interesting facts. First of all, around precious metals. The market share of precious metals and precious metals related assets in the US market is less than 0.5%, which is to say that less than 0.5% of all savings and investment assets in the United States are denominated in precious metals. That number is down from a 4-decade mean of 2%, pardon me. If the market share of precious metals and precious metals related assets were to revert to mean, that's all, just to revert to mean, demand for the stuff would increase fourfold. And that's precisely what I think is going to occur. JP Morgan Chase has been quoted as saying, although they don't have statistics to support it, that their estimate of the high point of the market share of precious metals and precious metals related assets was late 1981, early 1982, and they suspected the market share at that point in time might have been between 6 and 8%. I'm not suggesting to you, first of all, that number is right, or secondly, if it is right, that the market share of those materials would take out prior highs. I am suggesting that the market share of precious metals and precious metals related assets will revert to mean. Adam, I'm not even a trader. I answer a lot of questions on a lot of shows about the technical aspects of gold trading, like, is 2,410 some, magical resistance or something like that? The truth is, I don't own gold because I think it might go from 2375 to 2538 or some number like that. I own gold because I'm afraid that it's going to $7,000 or $8,000 or $9,000. And the set of circumstances that would cause that price performance would damage other parts of my portfolio and my life. And when I say afraid, Adam, I am actually afraid. I live a very good life, and the set of circumstances that would occur in a $9,000 gold world would be distinctly unpleasant. What gold has done for me and lots of other people over time has been to provide purchasing power insurance against the degradation that would occur in other parts of your portfolio if the circumstance occurred that would allow that type of exponential increase in the gold price. That's why I'm not a trader. I own gold for insurance. I own gold stocks because I'm fairly good at investing in them, and I'm an investor as well as a purchaser of insurance. When we don't engage in quantitative easing anymore, in other words, when the federal government doesn't counterfeit, when I have some assurance that that's true, I'll care less about gold. When when they balance the federal budget. Did you realize, maybe you probably do, your readers probably don't, the on-balance sheet liabilities of our federal government, not state and local, just federal, exceed $34 trillion? And a scarier number than that, Adam, is that the off-balance sheet liabilities, the net present value, not nominal value, the net present value of entitlements, Medicare, Medicaid, Social Security, federal pensions, military pensions, exceeds $100 trillion. Now, we're trying to dig ourselves out of this debt trap with an on-balance sheet budget deficit, unfunded on-balance sheet budget deficit that grows by $1 trillion every 100 days. So when I have to worry less about the unfunded and on-balance deficits, and when I understand how these future obligations, both to bondholders and to people expecting entitlements, can be satisfied, I'll sell my gold. That's when I do it. When Congress begins to act rationally, when the American voters begin to act rationally, I bet if you walk down the street in whatever town that you live in, and you asked random people on the street if they understood that the net present value of entitlements in this country was $100 trillion. By the way, that number comes from the Congressional Budget Office, not some cranky, bald old libertarian. That they probably wouldn't even know what the nature of the statement meant. I gotta tell you, I'm nervous about that. I had the interesting experience, not unpleasant, by the way, of talking to a sitting American congressman, I won't name whom, uh, and I was talking to this person about inflation, and the inflation number that they cited, believingly, was the CPI, 2.6%. This person said, well, while it needs to come down to 2.6 isn't the end. I mean, it isn't as concerning as you make it out to be. And I said, sir, you understand that the inflation number that you just cited is hedonistically adjusted, which means that the people who organize the statistic are the people who measure the value of goods and services. It's not a market measurement. Did you recognize, too, that when it doesn't suit Congress, they don't include food or fuel? This is problematic to me because I eat. And then I said, finally, sir, did you understand that using this as a cost of living index is sort of odd because it doesn't include tax? For me personally, taxes are a larger constituent of my cost of living than shelter, food, energy, and transportation combined. The look on the congressman's face indicated to me that he wasn't a pernicious individual. He was an individual that had never considered the problem in the way that I presented it to him. And for that man, for that reason, I mean, people elected a person who conflates the cost of living with the CPI. This is not good.